Hello, welcome. Thank you. Sorry, we're just sorting a couple of technical things out. Lovely to see you here again today. Day 4 of our MBA Alumni Dialogues. And we are delighted today to bring to you an MBA alumnus, Georgie Hazell. Georgie joins us from Augmentum Fintech, and she's going to share with you her insights and reflections from her career in her world of fintech. So fintech, finance, future and fairness. Georgie will speak for about 20 minutes, half an hour, and then she will take your questions. So as those questions or reflections occur to you, please add them to the chat, and then we'll have a sort of 20-minute dialogue session towards the end. Georgie, welcome. So good to see you.
Thank you for having me. Hi, everyone. It's nice to see some familiar faces. Right, let's kick off. So if I was to ask you to picture someone working in finance, what would you think? Would it be something like this? This? Or how about this? And now if I was to ask you to think of someone working in tech, same question, what would you think? Would it be this? How about this? Or this guy? My name's Georgie Hazell. As introduced, I did the Exeter MBA a couple of years back in 2017-18, which is where I first was introduced to the world of fintech through my MBA project with Crowdcube. I since moved back to London, and I've been working with heading up engagement at fintech-focused venture capital fund Augmentum, where we invest in fast-growing European fintech companies, financial technology, while these companies are still private. I also run a coaching practice, helping people find clarity and develop confidence, and spend a lot of my time working to support underrepresented individuals through my Women in Tech networking group to diversity VC initiatives and beyond. I also, in case you hadn't noticed, don't look too much like the photos on the last couple of slides, apart from perhaps looking a little bit more zombie-like thanks to lockdown. Over the next 30 minutes, we will be diving into the world of fintech, looking at where the industry came from, what's next, and the importance of sustainability and diversity in this exciting, much hyped industry. In half an hour, obviously, we can only hope to scratch the surface of this vast, constantly evolving world, but I hope to spark your imaginations, encourage you to think about the industry with a new perspective, and invite you to reflect on the implications of this for your own work and personal lives moving forward. And as Jackie said, we will have some time for some questions at the end, so please feel free to put these in the chat box and I'll try and get to as many as I can. And I will also share my details. I've got them here, so feel free to connect with me on any of those, and I'll also put them at the end, so if you want to follow up on anything that we didn't have time to get to. So, fintech. While the definitive birth point of the fintech industry really depends on your definition of technology, it can be helpful to think about some of the major milestones in innovation and world events that help pave the way for fintech as we know it today. For thousands of years, merchants have used credit to help their customers finance purchases. For example, seeds could be sold to farmers on terms that permitted payment after the harvest. In 1949, a guy called Frank McNamara was entertaining a group of dinner guests in a New York restaurant, only to discover he had lost his wallet. Luckily, the restaurant owner knew him and agreed that he would pay his bill on another occasion, an evolution of the farmers and their seeds. This embarrassing situation inspired McNamara to devise a card to prove the holder's identity and ability to pay. He launched this, the Diners Club card, the first modern version of the credit card in 1950, which is surprisingly, it feels like not very long ago. The world's first ATM was unveiled at a Barclays branch in North London in 1967. And magnetic strips gained prominence on the back of cards in the 1980s. This allowed them to be read by specialized computer equipment. The term fintech is said to have been coined in 1993, but didn't really become a household name until internet banking became mainstream. And the word fintech only actually entered the Oxford English Dictionary in 2017. So it's fairly new-ish by those standards, although variations have been going for thousands of years. We will touch on the 2008 crash shortly, but 2008 saw the launch of the mobile wallet in the Apple App Store. And blockchain has existed since 2008, and I'm sure many of you are familiar with this from the MBA and beyond, but interest really gained momentum in 2013 when the Bitcoin marketplace surpassed $1 billion. So that's enough of the history, but I mean, rewinding slightly, I mentioned the crash of 2008, and I just want you to cast your minds back there. Around the world, in the wake of the Lehman Brothers collapse, people lost their jobs, families lost their homes, and most crucially to this story about fintech, people really lost trust in the institutions that were meant to offer us financial support, trust in the people who would sign off our mortgage agreements, and trust in a system that was just fundamentally broken. This general distrust of banking can be seen as a real turning point that led to the creation of fintech as we know it today. Financial services needed to be reimagined, and the evolved customer requirements combined with the rapid development of new disruptive technologies and new ways of thinking really made this possible. Before this point, banks really had little competition, which gave them the power to monopolise financial services. They were able to charge abnormally high commissions, add in hidden fees, and inflate foreign exchange spreads. Consumers had little choice when it came to financial service providers, and so they had to play by the bank's rules simply because there were no other options. But in the aftermath of the financial crash, many highly skilled people who had been working in the finance sector decided to start their own companies, many taking on the very institutions that they had been brought up with and worked in before. VCs started to take note, and investment into fintech companies skyrocketed from just under $1 billion in 2008 to $35 billion just 10 years later. And last year, $4.1 billion was invested into UK fintech alone across 408 deals. The company that I work at was invested not quite 4 billion, but a little bit of that. It said that innovation precedes regulation. I'm preaching to the converted somewhat, speaking to a group of MBAs, but this was certainly the case with fintech. The crisis triggered a string of sweeping changes and regulations in the finance sector aimed at preventing such catastrophic events from happening again. So as an example, one of our portfolio companies is the SME challenger bank Tide, which some of you may be familiar with. This was a beneficiary of an £85 million grant split across two tranches as part of the RBS Alternative Remedies package, which was launched to promote competition in the market for SME banking services. Nowadays, more and more people are choosing to trust fintechs over their traditional counterparts, while competition over who can offer the fastest, most diverse, cost-effective range of financial services has never been more fierce, which is something that will only improve the state of the finance industry, thank God. The major banks and other financial institutions are both users of tech-enabled solutions, but are also trying to compete with the fintechs. Not always successfully, although I am biased because we invest in earlier stage challenges. RBS and NatWest's failed digital bank proposition Bo is just one of many examples you might have heard of a large established company trying, in this case unsuccessfully, to replicate the attributes of the challenger fintech banks. And it was announced yesterday that JPMorgan will be launching a digital first bank, which comes just weeks after the CEO, Jamie Dimon, told analysts that they should be, pardon my French, scared shitless of rival fintech challenges. Let me just change the slide. we're likely to see increasing M&A activity as established players seek to buy their way into the fintech space. You don't need me to tell you about the extent to which the unprecedented events of 2020 impacted the world, but one interesting implication of the pandemic was accelerated digital adoption. According to a McKinsey study, we saw 7 years worth of advancement happening in just a few months. In the UK, 6 million adults, which is 12% of the population, downloaded an online banking app for the first time during the first lockdown last year. And over 90% of face-to-face transactions made in April last year were contactless. The use of cash was declining before, but coronavirus for people in many countries globally have been forced to use digital payment methods. So contactless in shops, an increase in e-commerce across the board, but with notable shifts, particularly interesting shifts in the older demographics who sort of before were tied to sort of more traditional coins and checkbooks and were slightly more fearful of these new digital methods. So while of course there will be a bit of a resettling once the world opens up and some people will revert to their previous behaviour, for many people the fear of the unknown has dissipated somewhat and the convenience has been felt. So for many there will be no turning back. It's a real shift. So to the future. So we find ourselves in 2021, nearly February in fact, if you can believe it. So one step closer to a vaccine tipping point, luckily, not to mention the promise of a drink if you've been attempting dry January. Much has been written on the future of fintech. I don't have time to go into it all, but I wanted to just pull out 3 themes that I thought you might be particularly interested in. So the first is embedded finance. Fintech is everywhere. Embedded finance is best understood, sort of as it sounds, as integrating a financial service or technology with a traditionally non-financial product. It's an evolution we've been seeing picking up momentum over the last couple of years. This embedded finance allows companies to open up new revenue streams and reinvent the services they offer. It's not only great for those businesses, but also for user convenience. It cuts out several middlemen. To put this into practice and something practical, as an example, take the mortgage industry. People often think that they need a mortgage. They don't. What they need is to buy a house, or want is to buy a house, and a mortgage is just one of the boxes they need to tick along the way. So a good example of how embedded finance could come into play here is it's thinking about contextually relevant services. So, for example, an estate agent embedding mortgages into their offering. So by making it a core part of the house hunting process, they'd cut out the need for people to go to different places and have to source different services from different providers. There are many examples of this from transport through the likes of Uber offering in-app payments and Tesla offering instant insurance to buy now, pay later lending propositions such as Klarna in the e-commerce world, and telcos offering digital wallets and payments cards such as Orange Money. Long story short, as embedded finance evolves, rather than standalone services such as mortgages or loan, we'll likely see a boom in contextually relevant financial services. And when I was writing this and thinking about it, it really made me think of something I learned in actually probably my favourite module from the MBA from all those years ago, which was the Leading Resilient Organisations module with Karen Vanstone, which I'm sure some of you have done, and some of you will be, I imagine, looking forward to hearing from Karen tomorrow. I certainly am. But she talked about the permaculture principles, and it's a great metaphor for business and life more broadly, I'd say. But one of them that particularly resonates here and with embedded finance is the integrate rather than segregate principle. So if you're interested in that, I'd definitely suggest looking into the principles further and sort of reflecting on how that how apt it is really for a metaphor for the fintech industry. So open banking. This is a revolutionising technology bringing together fintech and banks. enabling data networking across institutions. Directly related to PSD2, which is the Second Payment Services Directive, it forces banks to release their data in a secure, standardized form for information to be shared more easily between authorized organizations online. It allows controlling consumers' banking and other financial information by third-party applications through data sharing with the help of APIs and artificial intelligence. Many industry players now predict open banking will reshape the banking sector as we know it, and I mean, it's already happening to an extent. Open banking is predicted to generate $43 billion by 2026. Open banking partnerships can provide consumers with a truly consolidated view of their financial accounts so they can be easier to manage. And as a result, the promise of open banking products and services is expected to promote better financial decision-making, lower debt, and improved long-term wealth generation. So benefiting all kinds of people, from the consumers to fintechs and the banks. It does raise some questions. It's worth mentioning, particularly around kind of data security and management of security threats. But there's a lot happening in terms of raising awareness and collaborating. Collaboration here is going to be the key to addressing those. And the third part in my sort of kind of three interesting themes for the future of fintech is DeFi, so decentralized finance. Cryptocurrency has been around for some time now and has received a load of attention thanks to its wild volatility and stories of overnight millionaires. But at its heart, cryptocurrency's promise is to make money and payments universally accessible. DeFi builds on this, so aiming to provide a global open alternative to every financial service used today. It's an ecosystem of applications and protocols built on blockchains, which support smart contracts. And they provide the same services as classical finance, so borrowing, lending, and saving. The difference is that they aim to do this in a decentralized way, meaning there's no middleman, no banks taking a cut of returns, and no central point of failure where the whole system could fail. 2021, this year, will likely see an influx of users and capital into the DeFi ecosystem, accelerating growth in the user base over and above the 11x seen last year. With a foundational understanding continue to be built in 2021, enterprise and institutional use cases, along with greater VC investment, will continue to follow. And at Augmentum, we just announced actually earlier this month an investment into a DeFi fund called Parify, giving investors exposure to lots of different companies in this space. We move on to fairness. So fair isn't often the first word that springs to mind when you think of the traditional world of finance, definitely not for me anyway. But evolving customer demands, combined with developments in tech and ambitious talent bringing new perspectives, mean that fintech has gone some way to address this, and there's a lot of opportunity there. According to the World Bank, there are 1.7 billion people globally who are unbanked. 1.7 billion, I mean, they don't have access to banking facilities. Many of these people are from developing nations, where penetration for mobile phones is pretty high, which actually has a lot of interesting opportunities in terms of sort of leapfrogging over some of the sort of tech developments along the way. And you know, they're the perfect place for perfect application in many ways for some of the fintechs and you know, branchless banking and that kind of thing. So fintech solutions like mobile money are playing a crucial role in improving financial inclusion in these regions, particularly in developing countries, but also further afield. We see it on our own doorstep. Innovative solutions addressing financial inclusion and related areas such as financial literacy are set to rise, making access to financial services easier, faster, and more convenient. Not something that you just try and avoid at all costs. Financial access facilitates day-to-day living. This is the point of it, really. It helps families and businesses plan for everything from long-term goals to unexpected emergencies. And as people with account holders, people are more likely to then use other financial services such as credit and insurance to start and expand businesses, invest in education or their health, manage risk and weather financial shocks, which can greatly improve the overall quality of their lives. Great strides have been made towards financial inclusion, although there's obviously a long way to go. But 1.2 billion adults worldwide have gained access to an account since 2011. And today, around 70% of adults globally have an account. Moving on to something that might be particularly of interest to some people because of the Exeter's MBA's focus. Sustainability, circular economy, ESG, these kinds of things. So the progression of the Sustainable Development Goals and the implementation of the Paris Agreement are arguably some of the most pressing initiatives of the 21st century. We've learnt how digitization changes the way financial institutions do business and the way that disruptive technologies challenge the status quo and allow us to experiment with new innovative business models. At the intersection of these, we have a huge opportunity creating a modern, sustainable financial industry that works for everyone. Around the world, governments and consumers are beginning to demand accountability and real change rather than pure lip service. And the UN Environment Programme Finance Initiative is a partnership between the UNEP and the global financial sector to mobilise private sector finance for sustainable development, helping to create a finance sector that serves people and planet while delivering positive impacts. You will all be familiar with the circular economy, and we're increasingly seeing fintechs adopting circular business models. So an example of this, 18 months ago at Augmentum, we invested in a German company called Grover, who have the circular economy at the heart of their business. So they've been touted as the Netflix of consumer electronics, so that they're a tech rental platform offering people and businesses a monthly subscription for physical tech products, giving customers the flexibility, but also allowing multi-use of the products and extending their lifetime. Anyone that knows me from the MBA probably knows that this is a particular area of interest for me. I'm particularly passionate about it. I mentioned permaculture earlier, and for this point, I wanted to reference the diversity creates resilience principle, which is something that I believe in wholeheartedly. Diversity of representation and thought within fintech is vital in creating the products and services that suit the modern world. Encouraging entrepreneurs from diverse backgrounds can address gender, cultural and ethnic divisions in the provision of financial services. There is a strong business case for diversity and change, which I probably don't need to go into. And thankfully, change is happening across the VC and tech ecosystems. There is just still a long way to go. So to put some numbers to this, only 9% of UK VC investment committee members, so the people that actually make the decisions, are women. There are less than 20 Black decision makers in VCs in the entire country, out of 1,700. And 39% of London's VCs, UK VCs, don't have any women on their investment team. Why does this matter? Well, it filters through to the investments. Over 90% of funding still goes to all male founding teams in the UK. 90% of Silicon Valley VC funding goes to companies led by, you guessed it, white males. And Black founders receive less than 1% of venture capital globally. Less than 1%. It's mind-blowing. So moving back to fintech and sort of the relevance of this, the founder of a really interesting social enterprise, STEMETS, the founder's called Dr. Anne-Marie Imafidon, made a really good point here. So she said, poor media portrayals, outdated cultural norms and stereotypes, unwelcoming cultures, and a lack of proper leadership are just a few factors that have led to homogenous finance and technology sectors. So it's unsurprising that at their intersection, fintech, we see the same pattern of underrepresentation. With the increasing sophistication of artificial intelligence and its integration into banking processes comes the potential for biases in the tech to amplify existing social inequality and erode trust between humans and machines. And I mean, this is really serious. So, I mean, a study into US mortgages found that both online and face-to-face lenders charge significantly higher interest rates to African American and Latino borrowers, which highlights how algorithmic bias can mimic the bias in manual processes carried out by humans and can potentially amplify it as the algorithm is deployed at scale. Early identification of bias is made easier if the teams developing the algorithms are diverse in their thinking, fairly obvious, and diverse teams with a range of backgrounds and experiences are just going to be in a better position to assess the impact of biased algorithms on potential outcomes, recognize the patterns and risks unique to their different experiences. And this doesn't just relate to tech and fintech, it's more broadly. You know, the key is to understanding you know, who you're working with, who the end user is. Diversity and inclusion are deep, multifaceted challenges, and while there are some important initiatives happening across the fintech and VC industries, which I can always go into more detail in if anyone wants to at the end, but it is something that all of us, no matter gender, race, anything else, we all have a responsibility to acknowledge and proactively address. So, to conclude, to wrap this up, the fintech industry is evolving at breakneck speeds. It's fast becoming an integral part of the global financial system, and yet the opportunity remains nascent, with incumbents still owning over 90% of the multi-trillion global financial services revenue opportunity. Here in the UK, we're at the heart of the global fintech sector, and for every pound invested in European fintech, more than half is invested in the UK. We're in an interesting position if you compare to some of the leaders in fintech over in the States, but they have Silicon Valley on the West Coast, New York and the so tech on the West Coast, finance on the East Coast within New York. In London, sure, smaller scale, but we have it all. We have it all here, and it's an area that's gaining increasing. There's an increasing spotlight on it from further afield, particularly from investors in Asia and the US. The past 12 months have seen a significant acceleration in digital adoption, as I said, in the wake of the pandemic, and have exposed many of the shortcomings of incumbent financial institutions, shortcomings that the more nimble fintechs can take advantage of and were already, but this has just accelerated it. Fintech is already playing a crucial role in supporting economic recovery around the world, as well as providing consumers and businesses a raft of flexibility to control their finances in just a more simple, transparent and cost-effective manner. Financial technology has become embedded in so much of what we do and the services we consume. I touched on embedded finance earlier, from digital banking services and the payment infrastructure underpinning retail and e-commerce transactions, to online trading and investment platforms and even transport. It could be argued that every company will be a fintech company in 10 years. And when answering the question, what is fintech? It's probably now actually easier to answer what is not fintech. At the beginning, I showed you some slightly tongue-in-cheek photos traditionally associated with people working in finance and tech. And if you didn't see yourselves in those images, which I imagine most of you didn't, I mean, I certainly didn't, I'd encourage you to think about whether you do now. My challenge to you going forward if you choose to accept it, is to question your assumptions about why things are the way they are. This is broader than fintech. But it's particularly relevant, I would say here. Could there be a better way? And most crucially, how can you take your learnings from the MBA and your unique challenges in work before the MBA and since, and be part of that change? So, thank you all for listening. I appreciate I've thrown a lot at you, and I could only, as I said at the beginning, I only even tried to scratch the surface. There's a huge amount that I haven't included, but they're my details. Feel free to connect on LinkedIn and Twitter, and also let me know if you're interested in exploring coaching or anything we've discussed today.